Okay, without further ado, ladies and gentlemen, we got a great one tonight. Man, you better get your notes ready too, right? Because you're going to have to put your thinking cap on. It's going to be a little bit more academic, a little bit more technical, but probably no better person to pave the way into this kind of topic tonight than our celebrity guest. And who is he? He is, ladies and gentlemen, he's the founder and managing member of KRI Partners. He's got more than 25 years of significant real estate, banking, private equity, and multifamily investing experience. You know, you take his career and you know what? He has been involved in, check it, more than $2 billion, that's billion with a B, of transactions. And that includes acquisition management and then financing of various multifamily real estate projects. And he's also a go-giver as well. He wants to have an impact greater than himself and his immediate family. So he's also, in his career, helped hundreds of investors reach their financial goals through real estate investing. And by the way, he's just one of Grant Cardone's Real Estate Club All-Stars, which is that's quite an honor as well, because there's some big ballers in there. But without further ado, ladies and gentlemen, let's give a big, warm Freedom Chasers welcome to Mr. Ken Gee.
What's happening, brother?
There we go. What's up, guys?
Hey, Ken. So glad you're back.
You guys are very generous. Celebrity. That's super generous, man. Thank you very much for saying that.
Stating the facts, man. Just stating the facts.
Thank you very, very much.
You're welcome. You're welcome. Ken, it's great to have you on. Marcel mentioned this at the beginning. This is the first time in Activation Zoom history that we've had somebody on twice now. And you're the first one to do that. And
that's
we're super
awesome.
excited. We're super excited to have you here tonight. And I'll tell you what, everybody that's tuning in live is here for a treat. But we had you on earlier this year, and we always like, granted, I mentioned it's going to be a little bit more academic and technical tonight, but still at the end of the day, when Ken Gee gets done doing his real estate thing, he's still a person. He's still a person. And I think there's probably a decent percentage here tonight of people that weren't there the first time where we dug a little bit into your story. So I think it would be at least worth it a little bit. Your story is super inspirational. As I was reflecting on our first Zoom earlier today, I think it would be good for people to know you on a little bit more of a personal level.
Yeah.
We can take a few minutes before we dive into the nuts and bolts of underwriting in today's market. So
absolutely.
Who is Ken Gee?
Absolutely. Yeah, Trevor, thanks so much. So I will try to abbreviate my previous presentation on my background, but you know, hearing you and your intro about what you guys are doing and what you're trying to do and how you're doing it, I mean, I was a freedom chaser. The more I think about this, that was me. I was in your shoes, sitting at a desk at Deloitte. I was a CPA, right? Pretty successful guy. But as you recall, I wasn't satisfied. And the reason I wasn't satisfied was, you know, my daughter was brand new as my second daughter. This is a long time ago. She's grown up now. But back then, I would do her night feeding. And there was a reason I did her night. First of all, I loved that time, right? Father-daughter time. Everybody else is sleeping. I mean, just think about that. Your fathers, you know exactly what I'm talking about, right? There's this the father-daughter bond, man. You can't. I don't know. There's just nothing like it. So
agreed.
What happened to me was I started to get frustrated, and I thought, wait a minute. It's 3:00 in the morning, and this is my time with my daughter. That's not cool. That's not cool at all. And that's when you see back then, I didn't call it a freedom chaser, but that's when I became a freedom chaser, because I realized, man, I went to school, got good grades. I mean, I was working at Deloitte, one of the biggest accounting firms in the world. I should be rolling, right? Everything should be perfect, but I couldn't find time for my family. And that really frustrated me. I couldn't figure out how I was going to put them through school without taking on tons of debt, because I just couldn't see how I would. I always had someone else in charge of how much money or how little money I made, and hope I give them a raise, hope I get a raise this year, you know, that kind of stuff.
Yeah.
You guys know the drill,
right,
man. You guys,
That's right.
Live in it.
I know you do, man. You just and you spend more time managing the internal politics than you actually taking care of your clients.
Yeah.
Man, this isn't for me. So I said I got to fix this. So that is when I started to figure out the real estate game. And see, this everything you guys are doing, none of this existed 25 years ago. I can't even begin to tell you that if I had you 25 years ago, my career would have just exploded so much faster, because
Wow.
my way of learning was going to an apartment association meeting with people that I couldn't relate to, and taking rental owners courses at night at the apartment association, and then trying to get to know the people who would lecture so that I could learn more. I mean, it was a really long, slow, grinding process. Took me a year and a half. I didn't have someone to vet an underwriting model. I didn't have someone to vet a Jerry Miles, right? And make sure that he's the right guy. I didn't have anyone to help me. Every single person I had to work with, I had to go through the hard way, calling lots and lots of people and trying to figure it all out for myself, right? You guys are doing that for people. I mean, it's unbelievable what you guys are doing for people. I just can't say enough good things about you guys. And that's why I keep
Thank you,
coming
Ken.
back. And that's why I keep coming in and listening to your Zooms, because every person you bring on, man, I learned so much. So anyway, let's get back to my
Thank you.
story.
We appreciate
So,
that.
Ken.
So
Definitely.
my story is, I bought 3 apartment buildings as I started to figure it out. They were small, only 28, 24, 22, something like that. Three different buildings. And I sold those buildings 3 years later. Now, remember, I was still working at Deloitte. And if you know anything about CPAs, which you just might, we worked a lot, like 70, 80 hours a week. It was brutal. And I sold those things 3 years later and made $500,000. I thought, oh my God, wait a minute. I thought I had a plan. I said, all right, let's go do it. Right. I took that step. I took action like you guys talked about, right? I did track number 3. Okay. It just took me a long time to get there. And I sold those 3 deals on the side and made $500,000. I said, you know what? I not only have a plan, but I know this thing works. And from that point on, my life changed. You see, because I thought I was doing it right. I thought all was good. But the real proof is in the pudding. When you sell those deals and you actually have this massive amount of money in your bank account, you're like, oh my God, this is unbelievable. Like, what the hell just happened to me? I mean, more money on the side than I did the whole time I was working there up until that point. Like, this is ridiculous, right?
Yeah.
So
Yeah.
this is really what happened to me. So then we just continued to buy more slowly, right? Because I'm a careful guy. And then I ended up doing exactly what many people on this call are trying to do. And that is, I got to quit my job. I resigned
Yes.
and made this my full-time job. And it is my full-time job, and has been and has provided incredibly well for my family. And I'm here to tell you, I did put both my kids through school with 0 debt. I'm so proud of that. And I am now here because I want to help people. Remember, I had a couple people early on. I didn't have no help, but I didn't get this kind of help. I mean, this is over the top kind of help, right? But I had a few people give me a helping hand, right? And kind of show me the ropes. Well, now 25 years later, I'm like, you know what? Early on, it was about me. It was just about me. I had to make money. I had to put do all these things for my family. Well, my family's grown and all that. And you know what? It now makes me happier that I can help someone else get into this business and change their life the exact same way I did. Because I'm telling you, the grind, well, you're living the grind. It sucks. It's a grind, man. And you just pray to God you don't piss off the wrong guy or gal. Because if you do, things are going to get really weird for you, right? It's just the way it is. And I no longer had to worry about that. So anything that I can do to help somebody through this process, and I will tell you, the reason I'm here talking about underwriting might have something to do with my CPA background and my commercial lending background and all that, right? But I'm really here to talk about underwriting because for 25 years, I've watched people try to get into this business. And many times, if not most of the time, they stop. They're working hard, they're doing everything, they think they're doing all the right stuff. And all of a sudden it comes time and they get scared. I know what happens because it happened to me. On my first deal, I can't remember if I told you this on my first Zoom meeting, but I had what I felt like was a golf ball in my throat. And it was like for a month. I'm like, man, do I gotta go see a doctor? Like, this is scary. I mean, it literally felt like a golf ball. It was hard to swallow. It was stress. It was stress. Well, I was thankfully able to push through that. But I watch every day people don't push through it because they just know, oh my God, this is millions of dollars. This has the ability to completely ruin my family and maybe my marriage and make me go bankrupt. This is really a big deal. And it's really, really scary. The reason they're so scared, the reason I was so scared is because you're not sure. You don't have the confidence. You know, I kind of know what I'm doing. I think I do, but man, I don't really know. And because you lack that confidence, it's so hard to push through that and get through it. I just know it is. It is really, really stressful. And so now I know it's underwriting that kills people because most people struggle with some of the numbers and it's kind of complicated, and it is. I try to make it really simple. I don't talk about debits and credits and all kinds of fancy terms because nobody needs that, right? I try to put it in real plain English so that it just makes sense. So now I'm back here and of course, we raise money, we invest in deals, we still take care of our investors. You know, we've got 250 some investors that we take care of. But more importantly, I want to help people get started because, you know, I'll eventually slow down in this business and they're going to ramp up. And that's kind of how the world is supposed to work, right? And so that's why I'm here. I want to help people get rolling.
That's right. That's right. Yeah, I love that. Yeah, I mean, Ken, I like what you said, right? You know, we've experienced that in the sense of that feeling that you get, whether it's in your throat or whether it's in your stomach, and you're submitting an LOI for X amount of millions of dollars, and it's like, oh my gosh, is this really happening right now? And there's a phrase that Victor says every now and then. It's like, what is it, Victor? The numbers are the numbers are the numbers, something like that. So at the end of the day, it all comes down to the numbers, and that's another reason why we were super stoked to have you tonight, talking about underwriting specifically, because it's such a weird time that we're in the market. Even just generally speaking, you know, not just geographically, but overall across the board. And to get some clarity and get some guidance from a seasoned professional like yourself, where we can have more confidence in underwriting deals and confidence in the numbers and slinging those LOIs is absolutely critical.
It is. I agree. I paid someone a lot of money on my first deal. I paid him $3,000. He was an attorney that owned 4,000 units. And I said, just tell me if I'm jumping off a cliff, is this going to be okay? He said, no, you're going to be okay. You're going to make $100,000 in 3 years. I said, what? He said, you're going to probably make, he said it very casually. Yeah, you'll probably make $100,000 in a few years. I was like, $100,000? Are you out of your mind? That's how much I'm going to make. Well, we beat that. But the point was, you need that person. You need that. You just do. And you should. The responsible person should have an experienced person behind them, just making sure that you're not missing something that's going to torpedo your deal. You know what I mean? Because there's so much at stake here.
And you spent $3,000, right? That $3,000, you know, could have also gotten you to, yeah, you're about to jump off a cliff, like, don't do it. But thanks for your $3,000, so to speak, right? I mean, you didn't know this at that point. You had to spend the money, you know, being well aware it could not be a deal, right?
I was trying to get rid of the golf ball in my throat, Marcel. Okay. That's what I was trying to do. It was real. I'm telling you, the stress. You know the stress, right?
I do. I know exactly what you're talking about.
You know exactly what I'm talking about. And now let me ask you: after you've gone through it and now you've closed, the next deal is going to get better. So, one, your first deal has to nail it, because your confidence will get destroyed if it doesn't. So you need that first deal to just go really, really well. And then when you turn that first deal and you actually, remember I said 3 years later, I sold those 3, that is proof, dude, I did it. Now I'm ready to go. Right. And now I was still learning. Okay. I still had an awful lot to learn. But remember, $3,000 25 years ago, that was a lot of money. Let me trust me. Probably today, I don't know, what is that, 5 or 6? I don't know. That's a lot of money to just give a guy.
You learn, right? You know, once you close your first deal, you know also, okay, this and this leads to this and this kind of problem. Now I know, like, okay, now I have to solve the problem, and you will solve the problem. That's not the issue. But now, you know, on the next one, you know what turns into what, so to speak. It's not the unknown. That's, I think, what's this feeling about the unknown, like, oh, I do this, but then what? You know, you tackle it in the moment, and that's like a little bit of an uncomfortable feeling.
It is very, yeah, because there's things out there you don't know. You just don't know what they are. I mean, you're smart enough to know you don't know things, but how can you know them if you don't even know they're out there, right? There's no way to learn them, right?
right.
Now, I will tell you, the guy that took my $3,000, he probably took me for a ride, but you know what? It didn't matter. He didn't spend much time and energy with me. I was disappointed by that. But in the end, I had a guy that had 4,000 units, at least take a look at it. And if you own 4,000 units in a market, you kind of know what's going on, right? That's what I paid him for. I paid him for that. I think you'll be okay, right? And he wasn't going to get any guarantees, but it was the push that I needed. It's like, come on, Ken, you're good. Just go. Just go.
That's great. That's great. Well, Ken, let's go ahead and launch into it. I know you have some stuff prepared for us tonight. And Marcel, I would say, typically I know we reserve questions for the end, and we can still do that, no problem. But also I would say, because this is a little bit more a technical of a Zoom, let's say if a question pops up in the chat that's directly addressing something that Ken's saying right then and there, let's go ahead and talk about it, if that's okay.
Yeah, Marcel, you know what? I would so much prefer that, because I don't want to talk at people I would much rather have this be interactive. Ask the question when it pops into your mind. And if it's a little off topic, don't worry about it. Let's talk about it, all right? Because I can come back to I can get back on track. Don't worry.
And for everyone to remember, the Zoom will be on the YouTube channel, right?
Yes.
So worst case, you'll still be able to rewatch it.
Yes. Except right. I need to be able to share, Mr. Web.
Are you able to share right now, Ken?
Not yet.
Oh, you're not. My bad. I have to make it. My bad. Here you go.
Now we can. Yes. Now we're good. Now we're good. All right. Are we good? Can we see it?
Yes, sir.
All right. So I'm going to minimize as much as I can on my little thing here so I can get rolling. All right. All right. I'm going to read this disclaimer. I hate reading it, but I just feel like I have to. I just got to make sure that we're all safe. Please note that and I'm going to move my camera to the side, guys, so you'll see the side of my face. Sorry about that. All right. Please note that investing in real estate and other financial instruments involves a high degree of risk and potential loss of some or all of your principal. This presentation is not an offer to buy or sell or a solicitation of an offer to buy any interest, securities, or otherwise participate in any investment or trading strategy. Any such offer can only be made through definitive legal documents, including the operating agreement, private placement memorandum, and other important subscription documents, which included information about risk of loss and other risk factors. Please note that nothing in this presentation should be interpreted as investment advice, tax advice, financial advice, or legal advice. Before making an investment decision, you should consult your own financial advisor. All right, everybody cool with that? Sorry about that. We got to get that out of the way. All right, so now let's get into some good stuff. So what Marcel and Trevor asked me to do was kind of compare and contrast what with the way things were, and we're going to define were loosely as maybe a year or maybe 2-3 years ago when interest rates were super low and everybody was going crazy, and compare that to now. And that's so I hope that because a lot of what you have heard, you hear people talking about is what was before. You got to understand what was going on before. You got to understand the changes that you're making in the way you think about this business now, so that you can adjust appropriately, because you always need to do that. All right, first of all, before, there were a lot of inexperienced investors. They're limited partners, okay? And the reason I say that is this whole thing came to be because of the Jobs Act in 2012. It took a few years for people to start getting ramped up. So people getting access to this kind of an investment it hasn't been that mainstream. It is becoming mainstream very quickly, and hopefully nobody screws it up so that we continue to grow this industry, because I think it's a massive way for passive investors to really change their life. Used to be that just the big boys got access to this stuff. There are a lot of inexperienced sponsors because, like anything, new markets always bring lots of entrepreneurial people. Whoops. There we go. I admitted somebody for you there. There you go. All right. It's easy. It was easy to make money. I mean, basically, if you had Heartbeat, you can make money. No one thought anything bad would ever happen. Preferred returns were normal on deals, 6, 8, 10% preferred returns, because they thought, this will be easy peasy. I should not have any difficulty, making these preferreds. Trevor, I just want to make sure you guys got these admissions. Okay, I'm admitting.
Yep. We're
Okay,
taking
cool.
care of them, Ken. No
All
problem.
right, brother.
Yep. Yes, sir.
MSA demographic information, nobody really paid attention to it much, right? They just, when I say MSA, you know, is the area growing? Is it not growing? Is it a big area? Is it a middle market, small market, tertiary market? What kind of market was it? New supply wasn't much of an issue at all. Now, the reason it wasn't is because the builders were just getting ramped up and they were getting ready to go. So that, you know, it takes builders a couple of years to put this stuff together, build it, come out of the ground, and then bring it to market. Exit cap rates, people were using flat. If they were going in at 4, they were pretending like they were going to exit at 4.
Wow.
Maybe they'd move a half a point, right? And when I say exit cap rate, so when you do your analysis, you're going to try to project how am I going to sell this thing and what's it going to be worth? And they were not planning for interest rate increases. There were a lot of people saying, and I understand why they were, but a lot of people were saying that rates weren't going to go up. They just were not going to go up. And although I could certainly understand why they said that, obviously they did. All right, let's talk about now. Everybody is becoming more educated. That's a good thing, right? But it also makes it harder to raise money because now you have more sophisticated and smarter LPs, which is, I think, really healthy for this industry. But it's why you need to be even better because they're gonna press you even harder. Now we've had some bad press because of inexperience and bad actors. I don't know if you guys, I haven't heard you talk about it on these Zooms, but I'm sure everybody knows exactly what I'm talking about. Some people kind of got too aggressive, lost a lot of money, and they, you know, anytime something disastrous happens, it's highly publicized. So that is now got people's ears perked up for sure. It is a lot harder to make money now because for lots of reasons, we're not going to talk about that, but just suffice it to say, it is, you can't just have a heartbeat anymore and make money in this business, right? You have to work for it and you've got to plan for how you're going to make money. People in general are a lot more nervous. They think the Fed's going to miss it here and drive us into a hard recession. That makes people very, very nervous. I will tell you that preferred returns are starting to go away. It's because sponsors are now realizing that those preferred returns that they promised, they're really hard to pay. And I'm sure many people on this, maybe, hopefully not many, but some people on this call have experienced distribution suspensions or even cash calls. And so not only are they not getting their prefs, but they're not getting anything. Weak MSA demographics are hurting a lot of properties. So if you think when softness hits markets, this is part of the reason why lenders, and Jerry will back me up on this, when there are major markets like Tampa or Orlando, those are big markets, right? When things start to struggle, when the economy goes into a recession, or when things start to struggle, they are not hurt as bad as the smaller tertiary markets because they're just larger. They can afford to have some people, fall out of the market, so to speak. Massive new supply in some markets. Now, this happens every single cycle, but if you haven't been in this business very long, you don't know that builders always overbuild. They just do. And it's hard for them because when it looks like things are going well, it takes them years to get this thing from concept to lease up. It takes them a while to do that. And as it turns out, they all seem to hit the market at the same time, right? So that's massive new supply in some markets, making markets softer than anybody ever thought they would be. Now we're using exit cap rates, a whopping 0.5 to 1.5 points higher, right? That's probably still not high enough, but that's what people are doing. And the reason they can justify not, think about that. If we're going in at 6, we're projecting an exit cap at 7.5. Like in our mind, we just think that's crazy. There's no way Florida's going to turn or trade at 7.5. But you've got to use an exit cap rate that's higher than your going in cap rate. So that's a little bit of then and now. Let me just keep rolling here. On the debt markets, are we still good, Trevor? You'll interrupt
we're
me,
still
right?
good.
All right,
Yep.
cool.
Yep.
All right, debt markets before, it was easy money, bridge available and common. Everybody could get a bridge loan. And the broker that's telling you to go get bridge debt needs to look at what the interest rate was because the deal will probably not work. The interest rates were about 4% all day long. You can get 4%. Improvements were easily funded with debt. That's cool, because now you didn't have to raise money from your investors to make the improvements that you were planning to make to that property. You could use it with, you could borrow the money. That's what bridge loans are for. Experience requirements were lower than they are. What happens in the banking world when they start to get stressed, I call it the credit markets tighten. I know you've heard that phrase. What that means is the banks start to bring in their requirements before they'll loan you money. And they want to make sure that whoever is in that GP pool has some experience, and they're increasing all of their thresholds. They're increasing their debt coverage ratio requirements, they're increasing their loan to value requirements, then they're increasing their experience requirements and everything else. That's how they tighten. That's how they batten down the hatches to make sure that they don't make bad loans in a time when everybody thinks there's a recession coming. Interestingly,
is there DSCRs a requirement for some lenders out there? Is it higher than 1.25 these days?
Yeah, depending. Yeah, I mean yes, some are. And so the less experience you have, that DSCR is definitely going to be higher. But yeah, I see some lenders what lenders partially use debt coverage ratios for is a way to tell you that they really don't want to do your deal. Hey, Ken, I'll do your deal, but I need a 145. Oh, yeah, you'll do my deal. That means you don't want to do my deal. But if I get you 145, you'll do it, right? What they're trying to do is they're trying to build in a cushion because they don't trust me or they don't trust the deal. Something's wrong.
Yep.
And that's why they're doing that. They're just being ultra conservative. 3 years ago. Oh, go ahead. Sorry.
I just gave you a 10-4.
Oh, cool.
Understood. Yep.
Before agency, nobody used the agencies. When I say agencies, that's Freddie, Fannie, HUD. They just weren't. Everybody was using bridge debt. And it's because the bridge terms were so much better for all the reasons that I just described. A lot of people, I don't want to say this out loud, but it's the truth. Many people were using variable rate debt just so they could meet the coverage ratio so that they could buy the property. There were even people that use what I call naked variable rate debt. That means there was no protection, there's no rate cap, there's no interest rate swap. Rates could go to the moon and they were fully exposed, and their interest expense there was no limit to what it could be. People were doing that. A lot of people, I think I mentioned that they're just making really bad interest rate assumptions going forward, right? Now, in their defense, I mean, if you told me that the Fed funds rate would go from 0.08 to 5, I'd have told you were crazy. There's no way, that's insane. But that's exactly what happened, right? So there's some things you can't plan for, but you also can't plan for rates will never go up because you just don't know. Now things are a little different. You can get your bridge debt, Trevor, you can go get your bridge debt, but the rates are going to be a lot higher than they were, and they're going to be far less eager to give you really high advances. They just are. Interest rates, easily 6% now, easily. On most deals, if you can get that right. And I think Friday, I think I saw the 7-year was at 380, 390, something like that. I mean, we're right up next to 6% because you're going to add 200 basis points at least to the spread to get your interest rate. Huge difference. Interest rate volatility is a lot harder, a lot higher. And this, okay, you got to really think this through to understand why this matters. It makes it really hard to do a deal. So think about this. When you go buy your single family home, what do? You go and you get pre-approved. Then you go find that house and you go apply for the loan and you lock in your rate right then and there. That's not how it works in our world. That's not how it works at all. You are so massively exposed in our world. In our world, we get to send right them the $25,000 deposit. You get to pay all your third parties. You get to pay an application fee, so that you can start the process, which will take at least 30, 60, 90 days, all the while you're watching interest rates go crazy on you, right? That's really, really stressful because you underwrote it at 530 and now it's at 590. Well, man, that's a big hit to your cash flow, right? But so that interest rate volatility makes it much harder to do a deal, especially if you're a syndicator, right? Because you're trying to figure out how much money to raise. It's just really, really hard to do a deal in that kind of an environment. whatever interest rates are, they are, right? I just need it to be kind of stable. I need to be able to know that I can go under contract and 30, 40, 60 days later, my interest expense isn't going to blow up on me after I've gone hard, after I've signed off on DD, after I paid out all this money for my third-party reports, all that kind of stuff. So this seems like it's not a big deal. Yeah, interest rates are volatile, but it's the reason it makes it so much harder is what matters, right? Because it's now you're just so exposed when you're trying to do these deals. Improvements now much more likely to be funded with equity. In fact, every deal we underwrite right now, we're not expecting any debt to fund our improvements. We're looking at equity. So what does that do? That drives down returns. That just makes it harder to get a deal because the alternative is to go to the bridge market, which sucks right now. Experience requirements are going to get scrutinized more carefully, right? For the reasons that I already talked about. Agencies now are a great option. I mean, I just put, within the last month, I put a refinance in place that I had a 3-year bridge deal and I was 1 year in. And I said, man, I got to get this thing locked down. I just don't know what's going on. And I got 2 years still, but I'm going to look forward and look ahead and get it done. And we were able to get it done, get a little bit of cash out, lock in a good rate at like 528. And so my rate cap, all is good, right? I was able to do it because the agencies are suddenly now a good option. And CMBS are not, bridge loans are not. And maybe there's a few banks out there. Most of them are too scared to lend right now. Operator experience now required is even more. I think I talked about that. It might be duplicative. Sorry about that. All right, so now let's get into how we underwrite. So before we were projecting income, right? Rents were going to go to the moon, and it was really easy story to tell. You agree? Most people would say, yep, okay, I see you're going to get $200, and I don't have any reason to doubt you because the whole world knows that rents are going up. So why would your story be any different? So it was easy. It was an easy story to tell. Softness. Now, here's what's interesting. When you did see a deal with softness in rents or occupancy that was bad, it just made sense. Well, the market's screaming. It must be bad management. It must be a bad owner, almost always. So it was easy to tell that story and it was easy to believe that story. And it probably was true. But the point is that it was an easy story to tell. I'm going to contrast that against now, which is not so much. The lease trade outs were incredible. Now this is good and bad. So when I say a lease trade out, if somebody moves out and you release the apartment, that's a lease trade out. Somebody renews a lease, that's a lease trade out, right? So it's old lease to new lease, and how much of an increase were you getting? And before, we still are at most of our properties, but it was happening everywhere where it wasn't uncommon to get $200-300 rent increases. We all know. And so what it did was, if you're buying that asset, you were very much willing to use negative leverage. We'll talk about that in a minute, because you knew you were going to grow your way out of it very quickly. So it didn't stress you, right? You feel very comfortable that rents are here, but I know I'm going to get them to this new place and it's going to happen really fast. And the reason is it's happening everywhere. Like, this is so obvious, of course it's going to happen. In terms of other income, we were just literally sitting around inventing things to charge tenants for. We just were, and we got away with it because it was just easy to figure out, hey, the market is so strong, and if they don't want to pay it, we'll find somebody else who will. That's the way a lot of people were approaching the market. I'm not saying that they shouldn't. I'm just telling you that's what they were doing. Rents going down in your projections? No way. Nobody was projecting that. Risk that the upside that you were projecting wasn't there? Nope. That nobody would even consider that possibility. Organic rent growth, at least 3 to 4%. That's what you were underwriting. I'm not saying we were. I'm telling you what the market's doing, right? So it was a piece of cake to make that story. It was just everything was screaming, right? We know that. Now, let's change things, right? Rent increase projections have to be scrutinized a lot harder. Why? Because think about all the headlines. Everybody is saying rents are softening everywhere. So now you stand in front of an investor or a lender or anyone for that matter and say, oh, I'm going to get $300 a month new rent increases. You're fighting, you're climbing uphill there. You are fighting the headlines, right? The headlines is telling everyone the rents are softening, yet you're trying to convince me that you're the only guy who's going to get $300 increases. You got to have a good story to tell. Before it was easy to tell, now you've really got to make sure you nail that down. Softness of rents or occupancy. Now you're not just blaming it on bad management. There's a real possibility it could be evidence of a macro problem, right? Softness in the market, recession problems, whatever it might be. But now the story's different, right? You're not willing to just chalk it up to terrible owner, terrible manager. That must be why the occupancy isn't as good as it should be. The lease trade outs, I'll tell you what we're seeing now. When we look carefully at rent rolls, and Trevor, maybe you guys have seen this, you see rents going up. If you follow the dates, this is where you got to get into the details. So we'll talk about this in a second, but follow the move-in dates for these people. You're going to see rents going up, and then you're going to see, in many cases, rents coming down. They're coming down because they have to come down in order for someone to rent that apartment. So what happens when you're seeing that too?
Well, I remember Victor making a comment, and I think it was maybe on like an OM we were looking at on a deal, and they were still projecting like positive rent growth. But if you took a look into basically like the renewals, right, and they were looking at rent growth over X of 6 months or the last year, right? But if you look at it, the last 3 months actually was taking a dip, and so they were building that into their larger timescale average, and it still was, of course, net positive, right? But it was trending negatively. Wasn't that right, Victor? Something like that. All right, we got a head nod.
You got a head nod. Okay, cool. No, but it's right. It's right. And the reason you notice that is because you're paying attention to the details, which is what I love, because so many times people don't do that. Now I'll tell you who else pays attention to those details: the underwriter for the lender. They are looking for this stuff, because now, before, they will be willing, your broker, your mortgage broker, can say, come on, man, give this guy a little bit more. These rents are going to be there 10 minutes after he closes. You can't make that argument anymore, especially if that rent roll, we call it, the rent roll is rolling over. That doesn't mean it's going to plummet and everything's going to go to hell. That's not what that means. That just means you need to be mindful that we don't have this upward trajectory right now, right? I wouldn't get too freaked out about it, but everybody's going to notice it, and you need to understand it, and you need to bake that into your projections.
Hey, Ken, you got a question?
Yeah, go ahead.
Go ahead, Marcel.
There's a good, I like this question that Leonard is asking here, actually.
Really good.
With mortgages, rates, and home prices being so much higher than 2019, wouldn't it be harder for people to buy houses, ? And would that make it better for multifamily investors? So that's a trickle down process, right? Yeah. But eager to hear your thoughts.
No, it does happen. That he's exactly right. When mortgage rates are higher, people can afford less of a home. But here's what and that's true. That helps us keep rents up, right? That helps prop us up, especially if you're in high demand markets, which we generally operate in. But here's what is making this a challenge for a lot of people now. People are staying in their homes longer now because they're in at 3%, 3.5%, 4%. They're not selling for anything, because when they go to put a new loan in place, it's going to be quite a bit higher. So the high interest rates will absolutely support us and continuing to help us raise rents. But if you're in a market that has some supply disruption, right? You have a lot of new supply, that's going to temporarily affect the market. If you have people nervous, that they're just nervous. People are nervous and they're not moving out. They're maybe boyfriend and girlfriend are going to live together instead of live separately longer. Maybe kids going to stay with parents. Some of that stuff might slow that down, right? So we'll see this. I call that rent roll rolling over. But I'm not. This isn't a long. I don't personally think this is going to be a long-term trend. It's just a hiccup. It's going to take a minute to work through whatever demand supply issues that little market is having, and then we'll be fine. So here's the challenge that we're having right now, though. Those high interest rates, we can't get sellers to sell their properties.
That's it.
And you know that at a price that makes sense. So we'll talk about that here in a second. If that's right, let's keep rolling.
Yeah. So
you do got to stress test your assumptions. The rents might go down, right? Before you wouldn't have even thought, oh, let's take rents down 10% and see what happens. I want you to stress test your rents and make sure that you understand what can happen, because before you ask somebody else for money, you need to understand how much room do you have there, right? And don't pay more than what you should for the property. Make sure you understand the risk of getting your upside. And then finally, organic rent growth. I mean, long-term, we've always projected 2%, even back when people were going nuts. Organically, we're doing 2%. And we're not going to change that, because over the long run, I think we'll be fine, even though we have a little bump in the road here.
Hey, Ken, can you go back real quick?
Oh, you bet.
Can you explain a little bit what you mean by make sure you understand the risk of getting your upside?
Okay, this is a good one. So one of the things, and we're going to talk about my underwriting course in a minute, but one of the things that I spend an enormous amount of time and energy on is, well, let me back up even a little bit further. How do we make money in this business? We make money by taking an asset, make it more profitable, throw off more cash than it did when we bought it. We increase the cash flow of the asset. Therefore, it stands to reason that most people should be willing to pay more for an asset that generates a lot more cash. Now, that is the premise of how we make money in this business. If rents never went up, we would probably never make money, right? So we need rents to go up. Now, you'll learn if you take my course, I break rent upside into 3 buckets. I'm assigning risk to my upside. I've got my first level of risk. So if I look and I see the current rent roll, and I look at what's called the in-place loss to lease, that means if every one of those leases went to what the seller has already shown me he can get for fair market value or current rents today, not even if it went down a little bit, whatever that in-place market rent is, that's an in-place loss to lease. In my opinion, that is the least risky component of your upside, because the guy's already proven it. You should be able to get it. He's already shown you that he can do it. The only reason all of his leases aren't there is because he just hasn't turned those units yet, right? But if you did, you should be able to get it. Then the next bucket of risk, so now we're going to go up the risk continuum here. The next bucket of risk is, all right, I've looked at what the seller is getting for his market rent, and I think he's probably still a little low. He may just really want to be full all the time, so he's there on the side of being conservative. I think there's maybe another $50. I'm making stuff up here, okay? That extra $50 is what I think is actually there right now without doing anything. I call that medium risk, right? And you want to understand how to identify that. And that's what we teach in the course. The third bucket of risk is, I'll call it the most risky, but it's going to see if you do your rent survey the right way, it is not that risky. But what it does is whatever's left over, let's say you think you're going to get $300, 150 of that is already in place. Another 50 of that is what you think is still there. It's just the seller hasn't gotten it yet. That extra $100 is the rent, is the upside that you have to work for, right? You have to go out and do something to make that happen. You've got to make the place look nicer. You got to improve the unit. You got to do something. So that third bucket is the highest risk in your upside. I like to know, especially in times like this, I want to understand when I tell an investor or a lender or anyone that I've got $300 in upside, I know exactly how much risk, I believe I do, based on my analysis of risk of getting that upside. If 75% of my upside seems kind of like, duh, it's there. I mean, it's already kind of proven. That makes me feel really good, right? If only 20% of that upside is already proven, that means 80% is on me and I got to go make it happen. That means that's just a riskier transaction. Now, I don't know too many people who drill down into the upside like this. I think it is important because when you're dealing with a moving market, you're dealing with you're not making a promise to an investor, but you're telling them what you think you're going to be able to do. You don't want to tell them you're going to get 300 if, man, I probably can only get 200, right? You don't want to do that. You don't ever want to be in that situation. So I like to understand my risk. So when I sit in front of an investor, I'm very confident that my 300 is there. Did I answer the question?
Absolutely, yeah.
That was deep. Sorry, man. But
That was
that's
deep. Ken, how do you think we're doing on time based off the amount of information we still got to cover?
I can speed it up a bit. We go to what time?
7:30 my time.
So what time is it? 9:30. All right, I'm gonna bust it out here. So we'll get rolling.
All right,
All
cool.
right. Projecting expenses before, very little rent increases, experienced sponsors, believe it or not, we're just using averages or sellers' numbers in their underwriting rather than going out and figuring out what they thought it was going to be like. Clearly, inflation was not much of an issue. Nobody thought about it much. And so that made projecting construction costs pretty darn easy. Now, not so much. 4 to 5% annual increases are definitely far more normal now. More sophisticated investors are requiring an explanation. Remember I said everybody's getting smarter because they've been there, done that. They've learned a lot as they've invested in deals. They want to know that you know why you're doing something and how you're going to get it done. That's really important. I think inflation is going to stick around a little bit longer than we want it to. So that means that, we just need to plan for that in our underwriting. And there is no question that some of the construction costs, costs to improve these properties have gone up considerably. There is no question about that. All right, overall, management was easy before. Like I said, you just had a heartbeat, you were good to go. Lack of experience didn't matter much, right? Because everything was to the moon. Napkin underwriting, there are a lot of people that believed that was really all they needed to do, right?
That's crazy, isn't it?
You have no idea. Yeah, you and I agree on that. There are a lot of people who don't dive into the details, and it's extremely dangerous. And those are some of the people that are in trouble right now. I will tell you the theme was to the moon, Alice, if you remember that old movie, that old series. FOMO was making everybody nuts. I mean, that part of the reason everybody was doing things, they just were really worried about being left out. They were seeing people make a quick hit real estate. That is never what real estate is supposed to be. But some people were getting the quick hit, so they were just really focused on, whoops, I went the wrong way. Sorry about that.
That was actually good, Ken. That was actually good because Mario, he actually asked a question about the 4 to 5% annual increases in expenses.
Yep.
And so could you he says, what specifically are you referring to, I guess?
Oh, I'm talking about pest control. I'm talking about landscaping. I'm talking about anything that has to do utilities, electric, water. I mean, everything. Just in general, we've never projected 5% annual increases before.
It's what happens in inflation, I would say, right, Ken? I mean, goods, services, that's just exactly what happens, right?
Absolutely. Yeah, that's what it is. You got to cover inflation. And if you do your projections and pretend like there's no inflation in the costs, I mean, that's just, no one's going to, I mean, you're just going to destroy your credibility because everybody knows there's inflation.
Mario, did that answer your question? Okay. Awesome. Thank you.
All right. Now, overall, property management has to be taken very seriously. This one gets me worked up every time I talk about it. Everybody has always thought you can ignore property management. Please don't ever ignore executing your business plan, right? You can make the best deal in the world, but if you screw up the execution of the business plan, you will lose money. In our world, that's simply property management. So whether you use third party or whether you do it internally, just take it very seriously and sit on it really, really tight. Lack of experience has been and will be the cause of a lot of bad decisions. I see it every day. And people are trying, they just don't have the experience. And because of that, they're just making bad decisions. But they think they're doing the right thing, but they're not. I will tell you that some sponsors and investors will lose money. Some of them already have. It's not avoidable. When you have this much movement in interest rates and you're not protected, I don't know how you could not have a loss of principal in some of these investments. Caution now is everywhere, and it should be. Here's what I'll tell you. I want to share this with you. I know that real estate is still a long-term winner. I want to share with you, and this is, I don't know if you guys will send out the slide. You're welcome to do that. But this is my personal wealth plan, the one that I started on a long time ago. I just put a nice, pretty little picture here. In this business, it is not unheard of to turn 100,000 into $1 million as a passive investor using annual returns that we get on a regular basis, that we're able to get, but I want to pay attention to one thing here. Years 1 through 5, 6 to 10, 11 to see, this is a long-term gig, a long-term gig. So imagine if you did this with 100, 200, 300, this will take care of you. Now, that's if you're an LP. If you're an operator, the all bets are off. This number goes up exponentially, right? Just because it does, because there's so much profit on the sponsor side. That's why everybody wants to do it. All right. So
Ken, could you just speak to this a little bit more in depth? So what exactly we're looking at here? Somebody who invests 100 grand and
Yep,
what that
so-
100 grand turns. Yeah.
yeah, let's take
Turn
it
it
through
over.
this. So let's say you invested 100 grand in one of our deals. Let's say you got a 6% preferred return. We held the deal for 5 years. That means you got $30,000 in preferred return distributions. We sell the property at I think it's 1.6x, and which is not uncommon. It's not out of the ordinary to sell it. We have total cash flow out of that deal of 192.5. We put in 100, we got back a total of 192.5. When we sell the property, we got to pay the tax man. I made a 15% capital gains assumption here. That means we have 178 and change left, which we're going to then go invest in our next deal. We're going to rinse and repeat, do it again. We're going to get our cash flow. We're going to sell the asset. We're going to pay our taxes and we're going to reinvest it again, right? You can see us just keep reinvesting.
Yeah.
That 100,000 turns into $1 million. This works. Our average returns are considerably higher than this. This is not an undoable one. I'm not promising someone that this will happen to you. What I'm telling you is this was my plan that I put in place a long time ago, and it has worked beautifully.
This is two things, Ken. Number one, this is you investing one time $100,000 and reinvest that, right? It's one single time, not like, right? Not like, oh, I got a couple more bonuses from work over the next 5 years and I start another 100K or whatever the case may be, right? And then one important aspect also is this 18.5% down here. Tell me if I'm wrong, but you're using the average annual ROI, right? So that's the average, like a lot of times you see on deals the IRR, right? Internal rate of return. So technically, Ken is being very conservative here, actually, because the IRR usually is lower than the AAR, right, Ken?
Yeah. The IRR, it's kind of hard when you're in a value add business. Most of our money comes in our business when we sell. So IRRs are usually going to be lower. Here's what was important to me. I didn't want to use a number here, an annual ROI that was, I mean, you don't know 18.5 is high. It is not unrealistic based on what has happened to us. That's how I set that, right?
Yeah.
And
I don't even think it's right. I think it's, I mean, for you, looking at your business, I don't even think that's high from what you see out there.
Well, I agree, but what I don't want to do is present a plan that is absurd, and someone says that I'm not going to be able to do that, because when I do that, people, they don't even try. They say that's not doable. That's ridiculous. I'm not even going to try. I want to make reasonable assumptions because this is realistic. Now, you said you get a bonus or whatever at work. What about using IRA money, 401k money? Think about that, right? Because you can do that in this business. This is why people are in this business. This is why everybody's going crazy for this business. This works. I'm telling you, this works. I am proof of that. I'm not the only one. Pardon me?
That's right.
You lived it. That's right.
I did, and I'm not the only one, guys. I did not invent this game. Okay. What I want to do though is get really, really good at playing it. That's what matters to me. And here's what you don't see. You don't see the quick hit, do you?
No.
And that's the bait that people take. All right, let me keep rolling here because I don't want to run you out of time. If you want to be a successful, here's what I'll tell you. This is going to get right back to the point that you guys made at the beginning of this call. You have to have time to really learn the business. You got to take the time to learn the how and the why. You got to really get into the details, right? You said, Trevor and Victor, you guys, or Marcel, I don't remember who looked at the rent roll, figured out that it was actually rolling over. That kind of stuff matters. Get a mentor. You've got to do that. I did it. You should do it. You just need to in this business. Do the hard work. I can't tell you how many times people resist underwriting. Whoop, why does that keep happening to me? Sorry about that. Why do people resist that? just underwrite for practice. Even though you're not going to do the deal, take it all the way through, go through all the little details. Every single time you do that, you're going to get 1,000 times smarter. Here's why. When the right deal comes, things move fast. Why? Because you're competing against guys like me that know what we're doing, right? You got to be ready to go. And if you use that deal to start practicing, you're going to get left in the dust. Do the practice while you can, right? And that's right now, all right? Make sure that you stay prepared for long-term success. This is, when I was preparing this presentation, I want you to just think about this. When you go to the doctor, you go see an attorney, a CPA, a financial advisor, a plumber, a builder, whatever, right? What is the number one thing that you expect? You expect that they know what they're doing. You don't hope, you just expect that they know what they're doing. You expect that they would have invested in getting themselves educated and trained so that they can do what they are telling you they know how to do. You expect that they will have studied under mentors, right? Think of a doctor doing a residency, a fellowship, whatever, right? They go through a lot of training to make sure that they know how to do whatever it is that they're going to do, so that when you go walk into their office, they know what's going on. They're not practicing on you. So here's what I would say. Let's get ready for this game. That is why I'm thrilled that Trevor has allowed us to be one of his, Trevor and Marcel and Victor, one of their partners. This is really an honor for me, and here's why. I set them this course, asked them to make sure they scrutinized this course. They looked at it themselves. They made it very clear that if they didn't think this course was everything I said it would be, they weren't going to endorse it. They weren't going to make it part of their program. So guys, I'm telling you, if somebody made it into that little partnership program, you need to take that vendor seriously, because I'm here to tell you, these guys did their homework, right? I don't think they're guaranteeing results, but I'm telling you, they did their homework. Okay, I think that's really important. So here's
and we learned something too, Ken.
Oh, you did? Well, that's good news.
100%.
All right, I'll put you on the spot. What is the biggest thing that you learned? What is one thing you learned?
I tell you what I learned. It's the spreadsheet that you put together, the napkin, essentially your napkin.
The deal screener, yeah.
Yeah, the deal screener is a lot more intensive than your actual napkin that you see out there floating around quite often right now,
Yeah.
And I like that. And one other thing is also that what you put in there, just because a deal doesn't check out, go back and check all the numbers in it and make sure everything is actually correct, because a lot of times stuff, messes up, happens, whatever the case may be. And because your deal analyzer is a lot more, and this is the napkin I'm talking about, right? This is the first step, is a lot more detailed. That's actually a very worthwhile comment. And I think it also creates a lot more confidence jumping into a deal more in the details, having a bigger deal analyzer on the front. Because how much time, everyone here in the call, how much time are you guys wasting by just using a regular napkin formula? That is cool. Don't get me wrong. It's cool, right? But then dive into the weeds and notice this is crap, right? But that's what I really learned and really liked actually in yours, was that there's a lot more meat to the first step. And it was still easy to maneuver, 5-10 minutes, not like big deal or so.
Well, good. That's awesome.
Yeah, and let me throw my 2 cents in here too, Ken. I think from like a high level view, what I really liked is, you're walking everybody through that's going through those modules exactly how you underwrite a deal. So you're talking about 25 years of experience of underwriting. There's like these little things that can be done. Like this may seem small, but like the color coordination of the rows in your Excel spreadsheet. And then when you sort them, you can see based off the colors very immediately, like, oh man, like I can get my upside here. Oh no, I can't get my upside here. Like these comps don't make sense, or these comps do make sense. I thought that was a real Jedi move that I was like, we need to make sure we incorporate that into when we're analyzing comparables and things like that. So, and then there was a bunch of like little Jedi stuff in there too, but that was one that was kind of at the top of my list.
It's efficiency, right? It's efficiency that I felt, and that's something that we struggled with in the past, I must say, efficiency.
Well, wow, thanks guys. All right, so let me tell you what you get with this thing. You get the course, right? It's me, If you got to like my voice, if you don't like my voice, then you're in trouble. But it's me and only me talking you through every single thing that we do. Everything that I talk about in this course, we actually do every day. I didn't create something that is different from what we do in our business every single day. This is what we do. I didn't leave anything out. I didn't add anything that we don't do. It's exactly what we do. So you get the course, the analyzer, that's the in-depth spreadsheet. That does your detailed underwriting, right? To give you everything that you need. I'm telling you, when you send that to your lender, they're like, oh my God, these people know what they're doing. It just speaks volumes. The deal screener, guys, in the beginning, I want you can use a deal screener, but I want you to do full underwriting. And the reason I do is because I want you to figure all this stuff out. Then use a deal screener to save yourself time. We use it every single day, and it saves us a massive amount of time. That rent stack template, that's what you're referring to. I like to color code things because I'm a visual person, helps me understand what's going on quicker, because otherwise spreadsheet with 100 lines on it, man, that's just too much for me. It's just too much for me to digest. I like colors, helps me out. Reference guides, it kind of takes you through, because what happens when you're underwriting is you get down into weeds, you get sucked in, and all of a sudden, wait a minute, all right, time out. We got to pull back out. Where are we at? What are we doing? Why are we doing what we're doing? I always want to keep people focused on that because I think it's critical. Now, this last thing we just added, and the reason we added this is because, people go through our course, and I thought, wait a minute, is there a chance that you're going to go through the course and absolutely understand absolutely everything, every single thing I say with just by, through the videos? Probably not. And so what I learned was, remember my guy I paid $3,000 to, right? We do a weekly Zoom call every Thursday at noon. I am there. It's Q&A, and it's whatever you want to ask me about this underwriting, right? Because you're going to go through the course. You're going to be like, I don't understand that. Why is he doing that? Doesn't make sense. I'm going to be there. It's going to be me on the call answering these questions. So that, because I really want you to get this done. I want you to get through the process, and I want you to make those offers and be confident, right? That's really, really important to me, right? I don't want to just sell you a course and tell you, I wish you the best of luck. I want to be there because I want you to get results, right? And I think that's critical. So the price, it's $9.97, the Freedom Chasers price. This is early launch pricing. It's going to stay at $9.97 for you guys for just the Freedom Chasers. Okay, everybody else, it's going to go up, but not you guys. Okay, so
amazing. Thank you, Ken.
You bet. That is, hold on, let me stop sharing. That is what I wanted to talk about. Hopefully I've added a little bit of value on the underwriting side. That course, well, you've been through it. So hopefully that that's going to be a value add for these guys. And again, I go back to, if something makes it into their partnership program, my friends, they have beat it up.
It's sometimes even uncomfortable. I tell you, Ken, it's so when we have some like yourself, right? Some very established people that want to be in the program, or that we have worked with before, actually. And we always say, like, number one thing is, hey, would love to, but right? We need to go through it ourselves, and it's such a fair question, right? If I have Elise, I'm gonna call out Elise now, comes to me and says, Marcel, you and Trevor and Victor, you say this underwriting course from Ken, we should do it. Tell me what's so special about it? Why should we do it? And I say, quite frankly, I don't know, because we haven't really looked at it. And
you would look at it, yeah.
That's terrible. That's terrible. That's not how we roll in this community.
That's not what you guys do.
Exactly. So we genuinely actually enjoyed it. Actually, I enjoyed. We did go through it together, and I have somewhere to go on the later modules. I know. I think I don't know how Victor and Trevor divided their share, but man, I'm looking forward even to dive into it deeper. Because the way we roll is obviously we have different roles on the team. So what's important for me is actually the deal screener.
That's right.
I noticed that. Yeah, I noticed that.
That's what's important to me, because that's what I do, and that's where I dive in. And I know Victor is diving into the details afterwards, right? So we enjoy that. I'm sure you'll actually see Victor on some of your calls as
I was
well.
going to say, I hope Victor's on the calls. I hope all you guys are on the calls.
Yeah.
And
Yeah,
bring bring hard questions. You do your best to stump me, man. I
100%.
enjoy that. It's kind of fun.
And we want to see more freedom chasers there as well. So that'd be exciting. But I
Yeah.
think it's a great resource, Ken, right? There's so many people charging actually quite a lot of money, you know, for this kind of stuff. And heck, even without the call, I think it's well worth it. And now with the call, that's like a mentorship actually almost, right? It's essentially almost that.
Well, again, guys, this goes back to 20 years ago. I was a different person. Now, no, I want people to get started. I want this to change their life because it did mine. I'm just telling you, it is hard to get over that first deal. It's just hard. And I want to be there to help you do it. I promise you, I'll be there to help you. Make sure your numbers make sense. I'll do my best to answer every single question that you have. Right. And, you know, maybe you'll stump me. I don't know, but I've seen a lot in 25 years.
So the way this works for everybody, right, is you go into the weekly underwriting codes that we have here. That's your number 101, right? Ken is not going to start from I would say your course is not for the ultimate beginner. I would say it's for somebody that understands at least, you know, what's a rent roll, etc. There needs to be a little bit of an understanding for multifamily, I think, right? So once you understand,
it's okay, but I can get them rolling. If they're brand new, they can still do the course and use the Q&A to ask questions like, I don't understand this.
Better.
Yeah.
Even better. But also for everybody that feels like, hey, I'm ready for this next level 101, right? Like I don't need 101 anymore. Next level stuff. This is what we mean with the preferred partners, right? This is where we have somebody like Ken now, you know, that on the underwriting side, for example, you can go to and elevate if that's what you choose to. If you choose so to do. I think that's my German mess up for tonight. That's how
that's all right. That was a good one. Hey, Marcel, you know, I these 3 tracks that you guys talk about really resonate with me. I told you that when we talked offline. That if you're going to be a passive investor, there is nothing wrong with understanding what's going on and how these deals should work. At least I don't think so, right? Because now that puts you as a passive investor in a better position to make sure that whoever you're going to invest with is done their homework because you kind of understand it even better. And then, of course, if you're going to be active and it's going to be your business, I mean, think about this, right? Do you expect your doctor to not have gone deep into the weeds on whatever it is that you're seeing them for? Exactly. I mean, you hope so.
For sure they
so
should.
Is the person that is you're asking for their money. They're expecting that you took care of business and you know your stuff. And if you just got to go there, it just makes everything so much smoother. It makes you a lot less nervous because you just know.
It's so true. I see Mario has a last question here, and let's see if we can accommodate it. We can certainly try. He says, any way Gabe can share his support and why.
Oh, what is Gabe? Is Gabe Bowling?
Gabe Bowling is in the house, Ken.
Listen,
what's up, Gabe?
I am always a student, and just so everybody knows, like Ken is my mentor. I seriously take like everything to him. Like I literally every deal that I've submitted on in the last year, I've ran through Ken because I look up to him and he knows exactly what he's doing. And I know that he wants to help them or help people. I am a living testament of it. I did my first deal, 8.2 million bucks, 55 units, Daytona Beach. The only way that I could have done that deal, guess who? Ken. Ken literally, he didn't need to do that deal with me. He could have just, here's a fee. Thank you very much for making me, you know, a lot of money. He let me in. He's genuine. He's like, I know a lot of rich people. Ken is the nicest person that I know, like from the bottom of my heart. So it changed my life. I've submitted on, I think I did the stats. It's either 88 or $92 million of deals in the last 90 days. All of it's because I've adopted the exact same model and the exact same criteria that Ken has. Like the exact way that I underwrite deals is with Ken's model. So it's like 997 is a no-brainer. So I would highly recommend it. Like from the bottom of my heart, changed my life.
Thanks, Gabe.
Thank you,
I'm
Gabe.
thrilled to be your partner. I have to tell you, people. How old are you now, Gabe?
25.
25. This guy is unfreaking believable for 25 years old, man. And he is just, I will tell you, I'm so impressed by Gabe. I invited him to speak at our firm-wide event that we had, what was it, last week? 2 weeks ago?
Last Wednesday, it was awesome.
That to help our people understand how to be a successful person, right? You're looking at him right here. So yeah, this is definitely a love fest. There's no question about it. I am thrilled to be Gabe's partner. I'm thrilled that we're gonna kill on that deal. That deal is killing. I am super stoked to be in that deal. It's only 55 units, but man, that thing's gonna make some money.
Well,
To the moon, Ken.
it literally changed. Like I will be like, I don't normally be like this open about it. I personally think I'm going to become a billionaire in this vertical, because of that first deal. That first deal, I can now leverage into my second one. Like I have a very large LP pipeline of equity because of the performance in that deal. So it literally changed everything.
Yeah, we did structure our deals such that Gabe could go through the entire process, but here was the key. Hopefully you don't mind me sharing this.
Yeah, go.
Cool.
I'm very.
I said, Gabe, I got my fund.
About everything.
If you don't raise a dime, it's no sweat, man. Don't sweat it. Okay. He went out, he did the whole process, everything, right? Went out, raised money, did the whole deal, right? Knowing that he had that backstop, that safety net. I'm telling you, if you don't have that, remember what I said, have a mentor,
Yep.
Have somebody, that safety net is so critical because Gabe, do things turn out the way you thought they were in the beginning?
Absolutely not. Guys, I raised $100 million working for Grant Cardone. I worked there for 3 years. I came out like I certainly had an ego. I needed something to check me, and that was it. I raised $910,000 or $915,000, and it was like hard. Links every single day on Instagram, phone calls. No, it's your first deal. You're 24. What are you doing? It was a big awakening. And be prepared. I do a 3-to-1 rule. Like if I'm raising $1 million, I want to know that I have now in today's environment, maybe even $4 million in my pipeline, because it's that hard.
Mhm.
So you see what happens. See, this gave me a taste. This is why I'm here, guys. This is why I'm here. Because I can do this now. And I want to do this for all your people, right? I would love to be everybody's partner. Okay. Gabe does the work. I went into that partnership with him very comfortable. Wait a minute. Gabe's got the work ethic. He's a nut, man. The guy will not stop where he will do whatever it takes. And he calls me all the time, Ken, what do we need to do? Do you need me to do anything? Whatever it is, right? And I knew I would get that with him, right? Those are the kind of people that you want to partner with, right? He never said, how much do I get? How much are you going to give me? He didn't do any of that stuff, right? I feel like we worked it out very fairly. But my point is that he is a good part of the reason why I've really focused my efforts on getting people educated here. Now, there's a little bit of self-service in this because I'm tired of competing against people who don't know what they're doing and they run up prices because they don't underwrite properly. I will tell you there's a sliver of self-service here, but I really want to get a lot of people started just like Gabe, because that's cool, man. That's cool. You can't, once you impact someone's life like that, it's done. It's done. You just did something really cool. And I'm really proud of that. So Gabe's amazing.
Yes,
Stick with Gabe. He's the man. I'm telling you, I don't know another 25-year-old like him. No way.
And Gabe is doing that to others now as well.
He
already
is.
at 25. So that's even more amazing, right? You put it in him, he puts it in others. I'm sure there's others already that put it in others because of it.
Yep.
It's amazing.
It's amazing. It's why what you guys are doing is just off the charts amazing. God, I wish you guys were around 25 years ago. You probably weren't even born yet. Some of y'all were.
Well, all the Freedom Boys were.
They were? Okay, good. All right.
Awesome.
Any other questions? Do they have the link to go out and get this course? I'm assuming.
Yeah, we have everything in the chat here, Ken.
Okay, cool.
Caleb always is a master of sharing the links. But one thing, guys, everyone, I always say this, right? Let's give Ken some love back, regardless of course or no course, or take action or no take action. Let's take a quick picture here and just thank him for his presentation tonight on our social media channels. Let's say, yay, let's go. Let's go. Because that's how we can share appreciation, right? With our channels, share with our network, so people get to know also what Ken has to offer. I'm sure he'll share it on his channel as well. I think your link, Caleb, can you put Caleb, can you put Ken's IG handle one more time in the chat, please, so everyone has it? I'll certainly post it after the Zoom here, and happy to obviously share everyone who tags us in there as well. Let's make a little bit of a buzz here. And Trevor, with that, I think, do you want to bring it to a close?
Let's bring it to a close, man. Ken, thank you so much again. This was amazing. Of course, it was one of those things where it's just like, time flies, right? Time flies when we're having fun. The value's just flowing through the Zoom. But we really appreciate you having tonight. Thank you so much for making it's really kind of a mind-blowing offer just for the Freedom Chasers with your underwriting course and then personal access to you on a weekly basis. And it means a lot to us having you, I guess, so to speak, in our corner and believing what we're doing. And even like you said earlier, right? When you look back on your story, you were a freedom chaser.
I was. I just didn't know it. Yeah.
That's right. You just didn't have that designation, right? Freedom chaser.
I wasn't cool like you guys were. I just knew I wanted to make a change.
Oh man, we're just dorky dads, man. Marcel's hat's pretty cool. That gives him some swagger points. But other than that, we're just trying to make a dent in this world here for some positivity. But thank you, Ken.